Hello, everyone. Steve Ankerstar here. Thank you so much for listening in. Welcome to the fourth quarter of 2023's Investment Advisory Board. Can you believe we only have one more quarter left in 2023? Some would say, considering the market in the past couple months, that's a good thing. But don't forget, 2022 was the bad year. 2023 was really a pretty amazing year all the way up till mid-August. And then, of course, September didn't help at all. We'll talk about the Federal Reserve. We'll talk about the other forces that caused the sell-off here lately. And I'll ultimately tell you how worried I am about it. Secret, I'm not all that worried about it. We're almost to the end of the rate hike cycle. We either have no more or one more, but the Fed's going to have to actually say the words, "We're done raising," before the market can find its feet and go back higher. But thanks again for being here. Please use the chat window for your questions, and I will get to those at the end. Okay, standard disclaimer applies. This is pretty much everything from the advisory board. This is our minds put together, our best forecast of what's going to happen. Obviously, that's not foolproof, but it's how we're positioning what we think and how we're positioning your portfolios going forward. If you have any questions on this or more, disclaimer information is available at ankerstarwealth.com. Okay, here's the advisory team. Here's what we do for you. You kind of know all that, but just as a reminder, we're going to make you as much money as possible within your risk tolerance level. That's that all-important risk number that we talk about pretty much every time we get together with a client to make sure that you're within that risk. If you remember, say, excuse me, say you're a risk 60, there's a range in there from 50 to 70. So strategically, it's like in the military, you're giving us your commander's guidance of you want to be at a 60, but we have the tactical flexibility to use our expertise to float between 50 and 70. So that's what allows us to kind of go more conservative. And right now, whatever your range is, the portfolio is on the more conservative side of that, kind of waiting for the Fed to finally say the right words before the market can turn around and go higher. So that's how your portfolios are positioned in accordance with the risk number. So that's number one. Number two, coach and mentor you through volatile times, making sure you don't make any mistakes. Just because you don't like what you see in September doesn't mean it's time to give up on, long-term investing. That's where we use the retirement charts to project how much money you're going to have throughout your lifetime and show you if you go to conservative, if you go all CDs, well, your money may not last you the 30, 40 years that you need to last it. So that you need it to last for you, I should say. So that's number two. And the last one is long-term financial and estate tax planning. Of course, you want to minimize taxes. Our goal is to make you as much money as possible. It gives you a tax problem, but then to turn around and mitigate that problem by doing appropriate tax planning. So happy to work with your CPAs if you have them, or excuse me, or I can get you a referral with some of the local CPAs I work with to kind of help you keep all that money you've worked so hard for. Okay, here's the overall numbers for the quarter. It's a different slide that you haven't seen before. This comes off of Advisor Stack, which again, Advisor Stack and Black Diamond are two of the firms that we're using now to kind of help us continue to build as a business. Overall, we came into the quarter 57 million. This was the quarter that had the TDA transition. So TD Ameritrade folks that were still with TD Ameritrade came over this quarter. That's at 8.65 million. And some other money came in. We made 3.51 in the market over the quarter. So again, July was a really good month. August and September, it seems like the world's ending, but as always, zoom out a little bit and you realize that that's not exactly the case. 2023 has been a fantastic year. We're just in that late summer doldrum, which is common for the August and September to be the two worst months. Guess what are the two best months? November and December. That's right. And they're coming up. So what I expect sometime in October is this, sell-off that we're having. We had two, especially this week, we had two big down days to start October. Today started down big, got all the way up to almost even in the Dow and the NASDAQ anyway. So we'll see what tomorrow holds. I am not worried about the market continuing to sell off at this point, right? The damage has been done. So we're going to move forward from that. So overall, that delivers us to 69 and some change million, excuse me. So that's where we are as a firm. If you think of where we were, kind of at the beginning of the year, the 50 million area, a little more than that, kind of continuing to grow on. So we're really on pace to get to that 100 million by the end of next year with, what you care about the most, great returns, especially in relation to what the overall market's doing. And then, of course, your referrals help. And then any new money you happen to bring on board, such as like right now, CDs are paying 5.75%. So if you do have a lot of money in the bank, consider bringing 50 or 100K of that into the account where I can get you a CD better than you can get your local bank. Again, that's all of us leveraging the power of Schwab, who can get these CDs at better rates, more so than, you know, our bank, who doesn't have the same power that Schwab has. So overall, things are going well. I didn't like August and September as much, you know, like you did either. But overall, things are going well. Okay, here's the overall book. We talked on the left-hand column. Overall, almost 70 million knocking on the door thereof. Assets under management, about 80%. We have another 13% of AUA. Those are alternative investments or investments held outside of your Schwab account, 529s, 401ks, all of those sorts of things that don't report directly to Schwab. And then we have alternatives, which is 7%. That's your private equity, venture capital, and things you see off in the right-hand column. Very little cash on hand. Through most of the summer, I kept quite a bit of cash. But now that CDs literally are paying 5.75 for a 15-month CD from JP Morgan, that's the best I have seen. You know, bought some yesterday, bought more today. That is amazing, right? So if you think back to where we were when interest rates were at zero, we didn't have that option. And I know I sat across the table from many of you and said the words, if I could just get 5% on a CD for you, that's all we'd do. Well, it's here. And that is what we're doing. So that 0.36 cash over across, you know, 70 million, that's not much, right? Because I've been going through your portfolios. And if you've seen me buy like a $4,000 CD, yes, they do make them that small. Schwab buys the big CD, and then they can parcel it out in $1,000 increments. That's what allows me to buy it, where you may not be able to do that at your local bank. But yeah, keeping pretty low cash on hand, just because it's time to put it to work, and it's time to get that CD that's going to be at least out there for a year and a half, because I don't see the interest rates being where they are today a year and a half from now. So that's what we're going for. Okay, standard investments. I switched the slide just a little bit because people didn't really care about the other ones. I asked a few folks and they're like, I don't care about any of that. So overall, I thought I would just say we're in 214 individual stocks. Again, that's kind of the highest risk, but it's also the most focused you can get for your portfolio is get to the individual stocks. There's no fee associated with those. There's no capital gains unless you sell them. So there's no surprises like mutual funds do all of the time when they give their capital gains distribution on, you know, your favorite tax day, December 28th or something like that, towards the end of the year, when there's nothing you can do about it. You don't have that with individual stocks. ETFs do kick off some form of distribution. Of course, there's a fee associated with that as well. So they're not as efficient, but it's a good way to focus, like on AI. ROBT is our mechanism for that. So that's how we invest in automated intelligence. There's 85 ETFs out there, and those are mostly thematic. There's 27 mutual funds. Why? Because I can't get rid of them, because a lot of times there's capital gains associated with them to where it wouldn't be right for the client. So we're kind of stuck in them from a tax perspective, but they're out there and they kick off, you know, and they have the big expensive fees, you know, and they're good mutual funds. You know, if it was just a dog, we would sell it. But if it's a decent fund and it's not too expensive and it doesn't crush your life every time you get this random distribution in December of the year, then we're going to keep it. If you are getting that big distribution, which I know some of you are, we're going to start working on seeing what we can do about that. 231 bonds and CDs. So yes, I owe more individual bonds and CDs than I do individual stocks. It's because they get better every day and it's easier to buy them every day. The bonds, I have to go and do a little more research as to, you know, what the company is and track record and, you know, long-term financial health. With a bank, I only buy from the best banks that are out there. So JP Morgan, Goldman Sachs, Bank of America, Wells Fargo, names you've heard of. Maybe you don't like. I know there's a lot of angst out there for Wells Fargo for some of the shenanigans they did, but it's CDs. So the big banks that are out there, they're not at risk. So we can pile money into those and take the return that they're offering. And then I do have a few options out there. There's a couple of covered calls in the book on large positions that we really can't sell because they're almost entirely capital gain. The far right-hand side of the book, this is accredited investor stuff. This is stuff that it takes longer to explain. Generally, there's more paperwork that you have to sign to get into these. but I will say this, the return is across the board larger. Now the risk is larger too, so it's not free, but it's larger return. And the best thing I heard from a conference I was just at a week ago was you're able to invest in the best and brightest ideas before they hit the public market. So you get in early, and a lot of these times you're putting money in them and you lock it away for a while, and you don't have the visibility like you can with your phone, checking your stocks every day. You can't call up Moonshots and ask them how their 15 companies that are all in venture capital state are doing, right? It's just not the information that you're normally used to have at your fingertips, but it's right for some people. And again, the return is there, which is why we participate on that. So as you kind of move up the food chain, if you will, as far as net worth, there's more and more interest into things like that. Okay, as far as the overall top 10 holdings for Ankerstar Wealth, they are right here. And what's so nice is that now that I have everything for the firm and there's 3 other advisors, so all 4 advisors, I have it all in one place. And that's at Schwab. So Apple's our top holding. If you see off to the right there, I have it covered up on my screen. I'm going to move that. 7 million in Apple. So, 7 into 70, that's right. That's 10%. So yes, heavily invested in Apple. It's still the best company in the world. Yes, the stock has been hit. It does that sometimes. Buy more. Most for you guys don't buy more because I generally have you loaded up on Apple. But certainly for a new client, their largest position immediately goes right into Apple. So from a money management perspective, these ups and downs of the market give me the entry point that I want to be able to put more money to work for new clients, especially into these areas that have fallen off. HYLS is an index fund that is in high yield. Let's go back to, there we go. High yield, again, we have 3 million in that. That's kicking off around 10% of a dividend yield, right? So it's a yield play. Google, you're very familiar with. The company's name's Alphabet. The ticker's still Google. And you talk about artificial intelligence, and people are like, oh, it's so new. Come on. I mean, how long? I mean, that's what Google is, right? So you type a sentence into Google and it scours in, microseconds, all the volumes of information about it and spits out to you, the best answer to your question. And the better questions you ask, the better the answer you get, right? So, if you put, how are the markets today? You might get all kinds of crazy stuff about regular, like markets in India, like street markets, right? But if you put stock market, and that's what you're talking about, or US stock market, right? So it's kind of the original AI, if you will. So of course we're heavily invested in that. We have Amazon. Just an amazing company that has been beat up a little bit, for sure. We have JEPI, which is a JP Morgan index fund that uses options to kick out income. So there's a lot of math behind that. I don't expect you to understand it other than conceptually. They have the underlying holdings of the S&P 500. They use advanced option strategies to create income, and they deliver that income to you. Kicks off about 10%. This is Blackstone Equity. That happens to be BCRED, so it's in the credit space. Again, this is an alternative investment. We have a couple $1 million of it, and it's something that would need to be explained to you before you hop in. BSV is a basic Vanguard bond fund, very cheap, tracking bonds. Again, bonds have sold off when interest rates go up, but now bonds are starting to turn, and they're going to get more popular when the interest rate starts going down. Bond funds will go back up. So you don't want to be late to that party. You'd rather be, 3 hours early than 3 minutes late when that turns higher. Cybersecurity, again, thematic index fund that captures everything to do with cyber. B&D is another basic Vanguard bond fund. And JPST is really a money market fund that pays just under CDs, right? So if you have a CD that's paying 5.7 right now, JPST will pay that like 4.9%. So you don't get quite as much. But you can also move in and out of it, at your leisure. So a lot of people like the liquidity there of, hey, I can just change my mind, move right back out. So that is the top 10 holdings on the equity side. Now, I will say in individual bonds, I talked about bond ETFs and how much money we have, but this is, if you look right here in the middle of the screen, you'll say total market value. These are the 231 individual bonds and individual CDs that we have in the book. So 8.5 million worth of this stuff. And this is a little bit of an eye chart. But as you look down the left-hand side, sometimes I got a special deal. That's why you don't recognize the name. But for the most part, you're seeing Wells Fargo, JP Morgan, Goldman Sachs, Fifth Third Bank, it's a regional, but since Cincinnati, I'm very familiar with it and very comfortable. U.S. Bank, I think I said Morgan Stanley, maybe not. But anyhow, all these CDs that are stacking up. Now, the trouble with CDs is they mature in short order, like, a year or 15 months, or if I set you up in a ladder, one's going to mature every 3 months. And right now, the getting is good, if you will, if you're familiar with that phrase. The getting is good. So right now, when it rolls over, it's easy to find another one to just add to your ladder. I will have to go to a different, tackle box of different lures when it comes time to, when interest rates start dropping. I won't have these CDs available for me. But right now, whether something matures or you're bringing money in from the bank, it's going right into a CD. It's locking in that 5.75% for you for, again, 15 months, or I'm laddering it right around that interest rate for you. So that's what's going on in the CD world. Again, it's not no risk, but it's U.S. Treasury risk. It's extremely, 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 extremely low risk. So it is the way to go. Okay. Why are the markets selling off? So kind of switching gears from where we are as a business and how we're positioning your accounts is to what is causing the stress out there. And I know that if you have watched, if you turn on CNBC or Fox News or CNN or wherever you consume information, that's all anybody is talking about is this 10-year Treasury curve. Well, yes, it is. A higher 10-year is bad for the market. Why? Okay. It's because now you can go out 10 years and get 4.7% and lock away your money and not have to participate in the equity market. Who's in that position? Well, folks that are, institutions for sure, that are like, we can make all of our budgets if we just get 4.7%. If you are an individual investor and you've already met the financial independent number, you can lock up your money safely for 10 years at 4.7%. You're not going to make a killing. You won't be able to brag at cocktail parties about how much your portfolio is growing, but you can make a nice return. So a lot of the money is flowing out of the equity markets into this longer portion of the yield curve. Okay. Remember, the Fed controls the short term and they're pushing that up to where it's above 5%, but it's like a tent pole, right? They can only push up the short term. The rest of it stays lower until the market. It's the market. It's all of us collectively that are moving money out to the 10-year to lock it in. That increasing duration I talk about is now increasing the 10-year. So you're like, okay, 10 years good if you're investing in either bonds or more CDs than bonds. But it can be good too, but it is going to cause a sell-off in the equity market. Will this last forever? No, I think it's peaked. I think it's actually overshot. So talk to me in 3 months, which we will. But I don't think it's going to be at 4.7. I think it'll be back more towards 4.25 or so. But when you see a chart like this, it does make you think, for all of the, economic experts that are out there, they look at this chart and go, okay, no way it can stay there, right? Because wow, look, it's historically high. Well, I want to show you this next chart. So this is a year-to-date chart. So obviously since January 1st, is it high? Yeah, you bet. It hit a low in around April of 3.3. Now it's at 4.7. That's crazy. Here's the 5-year chart. You say, okay, most people can, and this is why I say it's a shout out to use an older advisor. Not that the younger folks can't see this, but they would have to study it versus having lived it. Right. So 5 years ago, it's like, okay, well, 5 years ago, it was around 3%, dropped all the way to 0.5%. Wow, nothing. And now it's back up at 4.72. That's crazy. There's no way it can stay this high. Would be a conclusion that a reasonable, if somebody to write an academic paper that hadn't lived life could go, there's no way it stays up here, right, based off of this chart. Here's the rest of the story. Yeah, those of us who've got a 5 in front of our age or a 6, I would say even 6, and you've lived more of this than those of us with the 5 in front of our age. But yeah, it can get a lot worse. It certainly can. I don't think it will, but part of being a money manager is you do have to acknowledge it might. You can't guarantee that you're right, but you allocate capital in accordance with your own predictions of what you think is going to happen. I do think it's peaking here. I do think it's going to come back down. I do think that the Fed is probably either going to stop raising or just raise one more time. And then it's going to start looking more like normal. We'll hold rates up here at this 5+% for about as long as we can stand it. And we know that folks can't stand pain very long anymore, right? We used to be able to stand the pain a lot. Now we hold it till the middle of, maybe early next year, maybe the middle of next year, and then the rates start coming back down. The impact to the housing market has largely not been felt. We felt it a little bit in the stock market in 2022 when we had the big raises, but then April, we finally didn't have a raise, and then we kind of dorked around and had a little raise, and now it's like, are we going to raise or not? The Fed's being a little bit nebulous, which is causing some stress in the markets, but it's either no more or one more, and then the Fed to say the words, we're done. And of course, if they do continue up, I think they are going to break things. They've probably stayed, if you know my analogy about staying in the casino, it's like they've won. They engineered the soft landing, but they're still, they're too long in the casino now. They're there past midnight. Had one too many drinks, right? Because they're there and they're still kind of tinkering with something where they largely solved it. So I don't know why they don't take the win, but that's what, they're supposedly smarter than the rest of us, so they know what they're doing. They know what they're doing. That's what we have to hope. But even if they do have to have one more because they said they were going to, it's only going to be one. We're done raising hikes in 2024 is my forecast. 2023 is my forecast. So when 2024 rolls around, then now that market uptick that you see at the end of rate hike raising cycles can take place. Until then, drama. Somebody threw out this weekend, earlier this week at a conference, October 15th, is your date. If you look back in history, that's been the inflection point several times. Yeah, blah, blah, blah. You can't hang your hat on a particular day. But in general, I think in Q4, we get either 0 or 1 more rate hike, and then the market goes higher. Until then, it's just going to be kind of all over the map waiting for that to actually happen. Okay. Lastly, show you a quick shout out to our Advisor Stack portfolio. / Black Diamond. Again, those are software programs that are easy to make it available to you in the palm of your hand. If we sent you a login, one thing we didn't say is I didn't know is why I didn't say it. There's like a 48-hour time frame before that link expires. So apologies for me not knowing that. And of course, then since I didn't know it, I couldn't communicate it. So if you go back to the email from a month ago and try to click on it today, it's not going to work. But if you're listening to this and you're like, okay, I want to see this Black Diamond thing Steve keeps talking about, it is literally everything we have for you in the palm of your hand, whether you use it or not. Some people don't want it, don't need it, don't care. That's fine, but it's bought and paid for, and we have it all set up if you want to check it out. Like I said, ultimately, you're the customer. It's only whatever you want is what you should use. But it is, if you want to get into it, it's a lot of information, and it's accurate, and it's right in your fingertips, including at the bottom right there, you can see the Money Guide Pro, which is our financial planning software. It gives you your projection. So in this case, Mr. and Mrs. Example have a 99% chance of meeting their financial goals while they're here on the planet. Good place to be, right? Okay. Lastly, I want to brag about the team. Third quarter traditionally is the time when folks get out and have a lot of folks host conferences and a lot of folks attend conferences. In the past, I really haven't had the financial budget to support this. This year I did and went to several. You can see the team there in the middle. That's David, Joel, and I sitting at a Wealth Watch conference. We also just earlier this week went to the Fearless Investing, which is Nitrogen, which are the folks behind the risk score. So, and they have a bunch of new tools that are available for us. And again, some of it's just kind of fancy tech, and you're like, well, that's nice, but I'm not going to use it. But other stuff we do actually run our business on, and we brand around with our pamphlet. So when we talk to folks, we talk about the risk score. They're the company that came up with that fantastic conference, made a lot of connections, which is, again, half of it's learning and half of it's connections, finding new mentors in the industry, all of that stuff. So that's kind of the middle slide. If you start in the upper left, I was very fortunate to get called up by a reporter that I met at a conference a year ago. And he said, are you willing to go on record on a moment's notice over controversial topics? And I said, yes, I can handle the pressure. I'm a fighter pilot from, not anymore, but days past. It's like, pressure doesn't bother me. Sure. Shove a mic in my face and let's go. I was able to get on Investment News and give my 2 cents about the Fitch downgrade of the United States. Lower left's kind of going, if you would, counterclockwise. Lower left, there's Allison and I with the governor of Texas and the CEO of Texas Capital Bank at the New York Stock Exchange. So again, very blessed that I was invited to this event by the CEO of Texas Capital Bank here in Austin. Excuse me. What I call a bucket list at age 54. I did have a birthday a few weeks ago. Age 54 bucket list to go to the New York Stock Exchange. I'd never seen it. and to be able to get to go there and not only see it, but get really the VIP treatment. And it's such a privilege to take a family member with me. Irene didn't want to go, so I took Allison. And at age 19, she's standing, not only in the back. This was right behind the scenes, but also out on the floor of the New York Stock Exchange. Bucket list for me. She's already been there at 19. So hopefully setting her up for success. Shout out to the governor. He took an extra minute of his time. You don't see the big receiving line, right? So we weren't the only people there. But he did take a second to talk to Allison and find out a little bit about her. The standard, where are you going to school? What are you studying? And thank you so much for coming out. So you never know when a few words of encouragement can change a life. So thanks, Governor Abbott, for taking the time to do that. Continuing across the bottom, that's Nicole Malikowski, call sign Fifi. She's a professional speaker now, but she was also the first female fighter pilot to fly for the Air Force Thunderbirds. That was a goal of mine back in the day. I fell short of that goal. I got all the way to the finals. I got to fly with the team, try out. There were 8 of us left, and they picked 2 of us to go on to the team. I did not get one of those spots. As you can see, I'm a little taller than the average Thunderbird pilot. Fifi's a little on the shorter end, but she gave a fantastic presentation out in California to a bunch of portfolio managers like myself about risk and perspective and high performance teams. And of course, that's how I've designed Ankerstar Wealth to capture the experience I've had in military at highly performing efficient teams to again not only do what we do for you, but do it at a cheaper price than the market average, because we have the background that's taught us how to do that, right? Continuing on around, excuse me. You see the THP development sign there. That was a post came out earlier this week. The folks, that's where the new Ankerstar Wealth office is going to be. It is in the picture. If you see the LLC behind THP development and go directly up from that's our actual building. And again, I bought the whole building, so there's 4 different units. And again, the goal there is to better serve you, the client. So you don't have to come over to my house. I don't have to meet you out at Starbucks or Kirby Lane or Jack Allen's or all my favorites, or come to your house. We actually have a facility now that I'll be able to sit down in a professional conference room with you. And the side offices are going to be CPAs and estate lawyers, assuming I can find them, folks that I want to work with that are like-minded, that are going to be able to come in and sit there with us. So one-stop shop for your wealth management needs. I've always wanted that, and this is one step closer to that vision. Wish me luck, right? Because there's a lot I don't know about buying a building and designing it and setting it up and hiring people and all that. So, but I'm excited about the challenge, and I'm up for the challenge. I'll take your luck along the way. It's not a small task. Continuing over to the far right, where you see that yellow sign, that's Michael Kitsis. He's one of the mentors out there for advisors like myself that started out alone, where I had a solopreneur practice and transitioned it to where now I'm more of a CEO and a boss and managing 5 other people. I do have 2 contracts out for 2 more advisors. So, I could wake up tomorrow morning and there could be 5 of us. And, 6 total advisors, but in addition to the 4 we have, but 2 more is what I'm saying, or 5 in addition to me is where that number comes from. But anyhow, he's helped me through that. Finally, nice to meet him in person. Upper right, Dr. Jeremy Siegel, you see him all the time on CNBC. He's a professor. He's obviously been around for some time, and he wrote Stocks for the Long Run. He gave me we all got his book for free for being there, and he signed it for us. But yes, I think it's 6th edition of Stocks for the Long Run. So pretty special to have something, Dear Steve on it from somebody of that level of respect in the industry. And then the last one coming just left of that is Bob Pisani, who you see from CNBC all the time. He also has a new book out, which he signed for me, and I got to talk to Bob a little bit, and I got our picture taken, but I don't have a copy of the picture yet. So still working on that. But just wanted to brag on the team. Who's not pictured anywhere in this is Candace. Candace holds everything all together. She is complete quarterback, the glue behind everything. So she makes it look easy for the rest of it. Okay. Lastly, the forecast. As a reminder, what do I think is going to happen in Q4? I think that's where the bottom will be in the market. I think the Fed will be either 0 or 1 more interest rate hikes, and then that's going to mark the bottom in the market, if you will. So we had a terrible 2022, had a pretty optimistic 2023 for 7 months because the Fed was supposed to be taking their foot off the gas of the rate hikes. They have been They haven't communicated very clearly that they're ready to be done, but I think they are sometime in quarter four. And then in 2024, we can actually have a pretty decent year where we start looks like the beginning of 2023 again. If you have cash on the sidelines, CDs are the way to go, especially right now, because that will not last forever. All right, with that, I'll conclude. I look over in the chat window. I don't see any questions, but that's okay. If you're watching this on replay or you think of a question later, just reach out to the team. And as you know, we do pride ourselves on rapid response to client concerns, and we try our best. We don't always hit our mark, but reach out to us. We'll try to get you an answer in short order. With that, thanks so much for listening in, and we will talk to you next time. Bye.